In the early 1960s, a mathematics professor at MIT named Ed Thorp looked at games of chance and saw academic problems waiting to be solved. He believed that systems relying on luck could be beaten with pure data. To test this, Thorp built the world's first wearable computer to predict where a roulette ball would land. Then he turned to the blackjack tables, inventing a way to count cards. He realized that if you tracked the numbers closely enough, the house advantage disappeared. When the casinos banned him, Thorp took his math to the financial markets. He pioneered statistical arbitrage, a technique that used data to find tiny, mathematically guaranteed pricing errors between related stocks. He was turning consistent profits without ever relying on a gut feeling. Other brilliant minds followed. Jim Simons, a former NSA codebreaker, built a firm called Renaissance Technologies. He didn't hire traditional finance experts. He hired physicists and astronomers to build complex programs that could trade entirely on their own. These pioneers showed that the market follows hidden mathematical patterns. Machines can spot these rapid shifts in milliseconds, long before a human trader ever registers that anything has happened. To trade alongside these machines, we have to understand how they operate. While everyday traders spend their time chasing fast-moving prices, large institutional funds, the smart money, do the opposite. They quietly gather their positions over time, setting traps for impatient buyers. A common mistake is relying on a single thin horizontal line on a chart to act as a floor for the price. Institutional algorithms don't see the world in thin lines. They operate in broad, dynamic zones of supply and demand. Consider the stop loss, the safety net everyday traders use to sell their shares if a price drops too low. When a price hits that net, the retail trader panics. Institutional algorithms actually drive the price down intentionally to trigger those automatic sales, allowing them to buy all that freshly sold stock at a heavy discount. The market is an ecosystem of supply and demand. If you can't see the mechanics of how the largest players are gathering their shares, you're likely the one providing the fuel for their trades. We can see this institutional buying on a chart. Look at this specific downward red candle, marked here with a glowing box. This is an order block. It is the exact location where financial whales parked massive, unfilled buy orders right before the price surged upward. When those massive orders execute, they create an aggressive leap in price. The buying is so intense that the market skips over normal pricing levels entirely, leaving a clear, empty vertical gap behind. That empty space is a fair value gap. Because the market seeks balance, it acts like a magnet. Eventually, the price is drawn right back down into this empty space to fill those missing orders before continuing its journey upward. These footprints serve as readable receipts left behind by massive institutional trades, showing exactly where the biggest players have committed their money. But you have to be careful. Many traders draw these zones way too early, while the market is still moving flat and sideways. This diagram maps out a three-part trap called the AMD cycle. First, the price moves sideways as institutions quietly gather or accumulate positions. Then comes a manipulation spike, a sudden drop meant to trigger the safety nets of everyday traders. Finally, the price rockets upward in a distribution wave. An institution wanting to buy a massive amount of stock can't do it all at once without ruining the price. Instead, they drive the price down, forcing others to sell. The institution then scoops up those discounted shares in one big gulp right before the real move starts. A valid order block only reveals itself after you see that manipulation sweep. If you haven't seen the market intentionally trap impatient sellers, you are likely part of the trap. To find these setups, we use tools that cut through the noise. Think of the relative strength index as a speedometer for the market's energy. Rather than using fixed speed limits, modern versions use adaptive zones that stretch and shrink based on how the market is behaving at that exact second. We watch the speedometer for a warning sign called divergence. If the price is climbing higher, but the speedometer is actually dropping lower, the trend is losing power. The car is still rolling forward, but the engine has died. We pair this with a second momentum tool. By balancing how quickly the tool reacts to new data, we create visual bars that change color the moment the trend physically flips in our favor. High probability trades happen when these different tools all agree at the same time. You aren't guessing on a single signal. You wait for a mountain of evidence to pile up. Finally, we need a mathematical ruler to manage our risk, called the average true range. It measures how many dollars and cents a single candle moves on a normal day. This allows us to spot an unusual burst of energy. We wait for a single candle to explode in size, moving more than double the normal move shown on our ruler. Take Tesla, which starts the morning trading at roughly $271. Suddenly, the price bursts upward by $1.24. But our ruler says a normal move for Tesla is only about 50 cents. This jump is an exhausting sprint. Instead of chasing it, we wait for the price to drop exactly halfway back down, about 62 cents, letting us buy in at a discount price of $271.81. Because we've measured the market's normal range, we know exactly where to place our safety net. We set a stop loss 1 full ruler length below our entry. This gives the trade the mathematical room it needs to breathe, while we target a profit twice as large as our risk. By measuring volatility and waiting for institutional footprints, you stop guessing. You strip the emotion out of the process and begin to operate with the cold, patient precision of a quantitative algorithm.